Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, summer is well upon us in most parts of the world, and many of you are hopefully listening to this while taking a well-deserved break on a beach or a mountain or elsewhere. It certainly has not been a quiet summer for financial markets, though. U.S. tariffs remain very much center stage as Trump's prior 90-day pause, comes to an end. And within markets themselves, the rebound in the U.S. dollar recently has been another focus. Now, how should investors be responding amid all of these events? To discuss that, I'm joined by Fook Hien, who's a senior investment strategist in the CIO office. So, welcome, Fook Hien. Let's start with the US dollar. Now, we've been discussing the potential of US dollar short squeeze quite a bit in recent weeks since we published our mid-year outlook, and it looks like we're now in the midst of it. So, in your view, how should our listeners consider taking advantage of this rebound in the US dollar?
Yeah, thanks, Manpreet. The US dollar has rebounded from oversold levels on the back of US trade deals. You've got resilient economic and corporate earnings data and a relatively hawkish Fed. So we would use the US dollar rebound to reduce any excessive exposure to US assets and rotate to your relatively inexpensive Asia ex-Japan stocks and emerging market local currency bonds. In the Asia ex-Japan equity market, we are overweight on China and South Korea equities. The region is likely to benefit from easing trade uncertainty and supportive domestic policies. In bonds, we prefer shorter maturities given the risk of a delay in Fed rate cuts as inflation rises in the short term due to the tariffs. And we are particularly bullish on the short duration US high-yield corporate bonds.
Thanks, Fukin. Quite a bit to break down there, but let's start with the trade deals. Can you tell us a little bit more about the trade deals the US has so far achieved and what the market implications of those might be?
Yeah, the US has reached tentative agreements with the major trade partners, with the main exception of China and India. With the new tariffs would be implemented from the 7th of August. So partners with sizable trade surplus versus the US, such as the European Union, Japan, and South Korea, they will face a 15% baseline tariff, while most of Southeast Asia will face a 19 to 20% tariff. And Canada's exports, which are not covered under USMCA, will face 35%. Meanwhile, the US has extended a truce with Mexico for 90 days, with a similar extension versus China likely to follow. So while legalizing these agreements will likely take months, if not years, they do reduce a major uncertainty clouding global markets. The US-EU deal, it provides more support to European markets as the tariff rate is not as high as feared. However, markets have already priced this in. The equities there have been flat since the two sides reached an agreement on the 27th of July. The focus now moves to the US investigations on Section 232, which may result in an extended levy on European exports in some sectors to the US. That said, Europe's industrial sector is the bright spot within the region, and that's part of our opportunistic idea. The sector is a beneficiary from rising defense spending and the US-EU trade deal because of the zero-for-zero tariff policy, which is the elimination of tariffs by both the US and the EU across strategic products, including aircrafts and aircraft parts. And in our globally diversified allocation, we continue to favor Asia ex-Japan equities. We're overweight Korea within the region. The trade agreement earlier this week, it lifts a major uncertainty, and we continue to expect supportive measures from the government to boost shareholder returns and further fiscal stimulus, which should support a sustained valuation re-rating of the Korean equities. We are also overweight on China within the Asia ex-Japan region. Slowing macro data and a lack of policy stimulus at the latest Politburo meeting has led to some consolidation in the Chinese market. That said, such consolidations are opportunities to add exposure as the government steps up efforts to end price wars and tackle excessive capacity in China. There is still potential for fiscal measures ahead of a series of official meetings in the coming months, such as the Beitai-He meeting in early August.
How do you see tariffs impacting US inflation itself? Because that's been obviously quite a big focus for the Fed and its potential room for interest rate cuts.
Yeah, the 15% baseline tariff against the US key allies, it is higher than the previously anticipated 10% base rate. Now, the Yale Budget Lab, they estimate that the tariffs, after accounting for consumption shift, will raise the average US tariff rate to 17.5%, which is the highest since 1934. And this could then raise your short-run consumer prices by 1.8% and cut the US real GDP growth by 0.5% each in 2025 and 2026. So this puts the Fed in a dilemma, and there is a rising chance of a delay in the Fed rate cuts. We saw that this week, Fed Chair Powell, after holding rates for the fifth straight meeting, he declined to commit to a rate cut in September, citing inflation uncertainty. Also, we saw that 2 of the 11 Fed policymakers, they voted for rate cuts, and this is the first such double dissent in over 3 decades. The Fed will have 2 monthly inflation and employment reports before its September decision, and it will likely take a decisive slowdown in the job market in the next 2 months for the Fed to restart rate cuts in September. So the money markets, they are pricing just over a 40% chance of a September cut, which is down from a 90% being priced at the start of July.
So, in your view, what are the implications for investment strategies for bond markets then? We also saw the news, of course, that the US Treasury plans to borrow over $1 trillion in Q3. So, pulling all of these together, what does that mean for US long-term bond yields?
Yeah, we believe the interest rate volatility will persist, and we would add to bonds if the US 10-year government bond yield spikes above 4.5%. And then our preferred bond tenor remains in the 5 to 7 years. The significant increase in the planned debt issuance, it raises concerns about the long-term fiscal sustainability in the US. However, there has been a limited impact on US government bond yields, with the 10-year government bond yield showing little movement following recent announcements. Treasury Secretary Scott Bessent, he has indicated that the Treasury aims to avoid large increases in long-term debt issuance to manage borrowing costs amid rising long-term yields. Despite an expected increase in the supply of shorter-term bonds, the market sentiment and demand remains strong. So while the 10-year bond yield, it could rise to 4.5 to 4.6% due to market concerns about trade, inflation, and the government's fiscal position, we believe this would present an opportunity to lock in yields. And our preferred tenor of 5 to 7 years, it offers the best risk-adjusted returns in our view, balancing your attractive yields with fiscal and inflation risk. So investors who are a bit more wary of interest rate volatility, they could consider our opportunistic bullish idea, which is the short duration US high yield bonds. The short duration on the high yield bonds, they are less sensitive to interest rate volatility, and they exhibit lower price volatility and drawdowns compared to both your US high yield and the investment grade corporate bonds. And therefore, it does offer the prospect of a better risk-adjusted returns in our view.
Thanks, Fook Hien, for that short but very sharp, set of comments. I think we're coming to the end of the time available today, so we'll end the conversation at this point. So thanks, Fook Hien, for taking the time to speak to our listeners. If I can sum up the key points from our conversation, One area of focus, of course, on taking trades that could take advantage of rebound in the dollar, whether that's Asian equities or emerging market local currency bonds. Second, of course, European industrial sector equities as potential winners from the trade deals. And third, of course, a preference for relatively shorter duration, whether that's the 5 to 7 year preference at a broad level for dollar portfolios, or, of course, the shorter duration high yield opportunistic idea. So, with that, thank you very much for joining today's call, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the